What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Jacob Turner. In each episode, you'll hear us break down financial topics that are relevant to you and your situation. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
All opinions expressed on this show are for educational, informational, and entertainment purposes only. Nothing on the Long Game Podcast should be considered advice. Always consult with your team of professionals before making any decisions regarding your finances.
All right. Hello and welcome back, everyone, to another episode of Long Game Podcast. Today, we have a repeat guest. So if you've been following the Long Game for a while, you know Callie Cox. So she's follow her on social media is all I say. That's where we got connected. She's like one of the best resources for understanding kind of what's going on in the markets. So Callie, thanks for joining us, and maybe update everybody on your life. You've had a change in kind of where you're working, and let's just start there.
Yeah, well, first of all, I got to see Tom last week in California, and it was so much fun because I feel like we talk so much, Tom, but I've only seen you in person a few times. So
Yep.
It was great to see you again. I saw him at Future Proof, and yeah, I'm at Ritholtz Wealth Management now. I'm the chief market strategist there, which is a really vague title for being the chief market nerd or being the resident nerd that talks about markets and our investments and really makes the investing simple for our clients across our service tiers.
Yep. And the best thing is you're a normal person. We don't talk to you and feel like you are this nerd that's like, she knows what she's talking about, but like, you don't want to talk to her. Like, she's pretty boring. That's not you, obviously. So that's why we bring you back on. And, the one thing that I want to start this conversation, and, every time you're coming on, we're talking about the markets, is just, I think we just need to talk about interest rates, right? Obviously, rates dropped last week. And I think for a lot of people, they were surprised in how the market responded. And you had a bunch of really good pieces talking about this and had some data around, what typically happens after rates drop. And so I just kind of want to give you the floor of update us on what's going on and kind of your opinion on why the market has gone the way that it has since then.
Yeah, well, normal person is the highest compliment you could ever give me. So thank you. And look, the story of markets right now is, like you said, rate cuts. The Fed, which is this nerdy group of economists up in DC, they're in charge of interest rate policy and a few other things. They cut interest rates for the first time in 4 years last week. Well, we're recording on September 23rd, so I'm not sure when this will go out. But
we're going to get this out quick.
Okay, great. Well, they cut rates several days ago, and we haven't been in that environment for a while. The last time the Fed cut rates was in the dark days of COVID when we were all stuck in our houses. And, the Fed cut rates down to zero back then. We sat at zero for a while. And look, zero is not effectively zero. We didn't have, many of us didn't have access to like zero. None of us had access to 0% mortgage rates, but rates were zero for the Fed, and market rates kind of convalesced around that 0%. So market rates were really low. So mortgage rates were low, auto loan rates were low, consumer loan rates were low. We were living in a low rate world. And then inflation got really hot. 2021 was a little too bananas for people. And prices started to rise. And the Fed, being in control of inflation and unemployment and having to strike the right balance there, started raising interest rates to kind of cool the economy off a little bit. Unfortunately, that means higher mortgage rates, higher auto loan rates, better rates on a savings account, which is a nice silver lining. But now the Fed is reversing course again and has started cutting rates. But it's a hard thing for investors to swallow. And, I've talked to a lot of friends, family, and clients who are really worried that we're heading into a rate cutting cycle because a lot of us, especially younger investors, associate rate cuts with the COVID pandemic, which was a very scary time, and the global financial crisis, which is the last time the Fed, outside of the COVID pandemic, the last time the Fed that cut rates severely. So I think investors, especially, your age, my age, Tom and Jacob, we're used to rate cuts around desperate times. And look, this rate cut is looking a little different. The Fed is basically saying, we're done managing inflation. We think inflation is at a good level. So we're gonna bring interest rates down a little bit. We're gonna get our foot off the brake.
Yeah. And I mean, how are you thinking about the decision post this, right? Because I've had the same conversations, and I've had people reach out to me and say, "Oh my gosh, like what do we do here?" And in my mind, I was viewing, okay, ahead of this, I think that they're actually going to make this cut. And I think it's actually going to be really good for the markets. And I think it's going to, we don't even have to get into the world of like how this impacts private equity and investing in other businesses and all of that. Like, obviously, it's a good thing there. But in my mind, I was actually putting some of my clients' portfolios into more equities ahead of this because I thought it was the right time. But like for you, when people say, how do you view this as a positive? What's your answer?
Well, for a lot of things that I study, I think you have to view them in context. I'm the biggest fan of market history. Tom knows on Twitter. I post market stats all the time. But one thing I've learned throughout my career is that context matters so much, and people rarely dig into context because it's so easy to post a 280 character tweet and just move on. So with rate cuts, context really does matter. Actually, I'll throw some stats at you. I'll live up to my market history claim. Since 1970, the Fed has cut rates in 18 rate cutting cycles. So not just individual rate cuts. I mean series of rate cuts. They've cut 18 times, and seven of those 18 times did not overlap with a recession or an economic crisis. The Fed was simply just adjusting policy down to a more, Wall Street calls it neutral, I'll call it normal, but a rate that's not helping the economy or hurting the economy. And so there's precedent here, first of all. And the other 11 times, the Fed was cutting around a recession. A recession was around the corner, or a recession was already happening. And what you can gather from that is that, the economy can be in different states when the Fed has to adjust rates. But when the Fed is simply cutting as a celebration, that's what we call it, instead of cutting out of desperation, then the stock market actually does quite well. The swings aren't as big. And I think maybe every time, I'd have to check my data, but every 12 months after every single one of those 7 rate cutting cycles that happened outside of recessions, stocks were higher 12 months later. So I try to remind people about this because the last time we really saw a rate cutting cycle that didn't happen in recession was 1995. I was 4 years old.
I was
Many of
born.
us, oh man, Tom. Oh man, we got to talk a little bit about this then. Back in 95, when the Fed had to cut rates to, balance out the economy a little bit, it wasn't this big disaster. It was a big conversation in markets, but it wasn't the beginning of something bigger and more ominous. And we may be at the same point today.
So let's talk about the other 2 times after that, right? I think these are the ones that most people remember and think about. Talk about the context of the next 2 ones where we declined rates.
So you're referencing the financial crisis and the pandemic?
Yes.
You want me to talk about those? Yeah.
Yeah. I just think going in there, because again, you're hitting on this context a lot. And I think that's what most people are missing. And I don't know if, I think some people say that it's not that they're missing. It's they say, well, I saw the jobs reports and I saw the thing. So like maybe the reason why they actually did make this decline and they actually did 0.5% versus a quarter is actually because the economy is in a worse spot.
Yeah, totally. And look, heading into the rate cut, I was a little worried that cutting 50 basis points, which by the way, 50 basis points, 0.5% doesn't sound like a lot, but when your interest rate is around 5%, that's a pretty good chunk.
Yeah.
It's actually 50 basis points is about 1/10 of where we are. So it matters, right? Market math is just different. But I was worried when there was talk around a 50 basis point cut versus the more normal, more gradual 25 basis point cut, because it does insinuate that something could be wrong. If the Fed has to cut quickly, then, you could get some speculation that there's something wrong and the Fed is trying to get ahead of it. I don't think that's the case this time. We saw pretty big cuts in the global financial crisis and in the COVID pandemic, and 50 basis points is actually quite a big cut. But the Fed, and I think Jay Powell did a good job of this, but after the decision, Jay Powell came out in a press conference and just said, we're a far ways away from normal and we want to get back to normal as quickly as possible. But normal is the key word here. We're not cutting rates down to 0. We're not going back to where we were in the 2010s, at least not now. And while the job market is slowing and hiring is definitely slowing down, that's not good. We're not in desperate mode yet. We just want to calibrate things a little bit and see how the economy responds to it.
Well, Callie, you mentioned normal. So from the data that you have and from the context that you just shared, what do you see normal looking like in the future, whether that's 12 months or 24 months in the future? If we're, and obviously we're taking all the numbers we have and we're making our best estimate on what we think rates might look like in the future, but what do you perceive that normal looking like?
Oh, that's the $1 million question on Wall Street these days. I don't think anybody knows what normal looks
That's
like.
why we brought
Even
you on. I thought you had the $1 million answer for us.
I know. Well, let me break it apart for you, and maybe everybody can come to their own conclusions. I'll start with this. So, Fed members do us a big service. Every other Fed meeting, they put out rate projections, just where they think the Fed's policy rate will go over the next year, 2 years, and then the longer run, which is this nebulous, in the future, longer than 2 years type period. So, I mean, when I say everybody's guessing, everybody is guessing, and Fed members put out their guesses, and the Fed publishes these guesses and says, okay, well, the median guess is, maybe a good indicator of where we'll go, but it'll change probably. So at the last meeting, actually, back, several days ago when the Fed cut rates, the Fed issued these projections again, and it looked like the longer run rate would be around 3% or so. So a Fed policy rate at 3%, right now we're at 4.75%, which means I take it to mean we could see more rate cuts. I mean, certainly if the Fed wants to get back down to 3, then we've got a ways to go. 3 is not 0. So you got to remember that the Fed policy rate was at 0 for several years in the 2010s. So the Fed is saying right now, we're not going back there, and that's a long ways away. I believe them based on what we're seeing in the economy. But the other thing I found interesting is the pace of rate cuts. So we saw a 50 basis point rate cut to start things off. That was a little shocking, but Fed Chair Jay Powell was very intent on saying, we want this to be gradual. We are cutting on our own terms. And if we can retain control of this narrative, it works out best for everybody. The economy hopefully responds. The markets keep confidence in us, which is really important. And, hopefully we can slowly move back toward a better balance. So inflation doesn't, fly off the handle again, but the job market also doesn't fall apart. So I know, Tom, you asked about the last 2 cycles, and I can't express how different this cycle looks than the past 2. I mean, when the Fed started cutting, we were on the cusp of recession back in 2007, actually, is when they started cutting. And you could see consumer credit becoming a really big problem. Today we have our issues for sure, but households are very strong. I mean, in general, American households are very flush with cash, and you're not seeing the type of lending or the type of credit use that you saw back in the 2007s, 2008s. Fingers crossed that means no housing crisis that, throws the world into a frenzy this time around.
Yeah, and with rates dropping, hopefully that helps, right? I mean, we've seen the stats over the last year or so that like people aren't really buying homes and people aren't really moving, and working with people, I see that day in and day out, right? It's really hard to say I have a 2.25% mortgage and I need to go bigger, and now I'm going to pay 2.5x what I was paying before. But I really think this context thing matters so much. I love the way that you've talked about it, because that's how I viewed it too. But when they did 0.5%, for you, did you second guess the context and you're like, ooh, is there something that we don't know? Because obviously we were all at Future Proof, and this isn't a podcast for financial advisors, so just know it's a conference for financial advisors we are all at. And I was talking to people, we were talking to people, and this was a hot topic, and a lot of the people there are like on CNBC and other things talking about it, and they're like, no way, there's just no way it's going to be 0.5%, and if it is, we're a little worried.
Yeah, well, it goes to show you how silly Wall Street can be about some things. And to be fair, if people asked me, I was like, you know what, gun to my head, they'll probably go 25 basis points. But look, first of all, it's really hard to speculate on decisions like this. You're not in Jay Powell's head. So
No.
ultimately, nobody knows what's going to happen. And I don't think he doesn't know until he enters the meeting and talks to the voting members of the Fed. But when I saw that the Fed cut 50 basis points, my first reaction was, whoa, they actually did it. I never really questioned the economy. I feel like I've studied the Fed enough that well, first of all, the Fed likes to kind of prompt everything it does. So it was a little shocking that they cut 50 basis points because there was no prompting around that. The only big hint that we got was at Jackson Hole, is this retreat that Jay Powell speaks at every year. Powell said it's time to cut rates, but he certainly didn't say it's time to cut 50 basis points. But when I saw it, I was a little shocked, but I wasn't necessarily concerned because, again, in the context of where we are in the economy, it does make sense to get back to normal as quickly as possible. But normal isn't zero. And
Yeah.
I keep stressing that to friends and family. Mortgage rates are around 6% right now, but the
Yeah.
chances that they go back to 3 are so small. You might see
Yeah.
6 to 5. You might see your savings, the rate on your savings account come down from like 4 to 3. But the time of 0% savings rates and 3% mortgages is just so far away from us, unless something
Yeah.
really bad happens, and that doesn't look to be the case yet.
Well, it's funny how many people don't realize like they're the opposite side of the same coin, right? Like I even saw financial advisors in a community was like, oh, bank account ready moved 0.5% down. Like, of course, it didn't even take them a day. It's like, yeah, but then you saw mortgage rates. Like, you can't want instant changes on debt and then not expect instant changes on cash, right? And like, I mean, as you know, I think at the end of the day, you'd much rather have debt be cheaper than have slightly higher yields on cash for most people, unless you're potentially retired. If you're accumulator, if you're in your 30s and 40s, cheaper debt is going to be a better thing for you most times.
Yeah, and I want to make something clear too. So savings accounts and money market rates tend to move with the Fed's policy rate. Those are
Mm-hmm.
short-term rates. But when you start talking about mortgage rates, auto loan rates, you really have to watch the treasury market and where the 10-year yield is going, for example, to understand, what mortgage rates will look like in the days ahead. I think that there's this misconception that when the Fed cuts rates, it cuts all interest rates and they all move down by 50 basis points. But that's not necessarily true. So I said a few minutes ago, maybe mortgage rates go from 6 to 5. I actually can't like that's a lick my finger and put it in the air type thing. Nobody can tell you like where market rates are going, but Fed rates are actually really closely tied to your savings account. So in a way, you can anticipate where those savings rates can go, even though ultimately it's a business decision. Like a bank can do whatever they want.
So, Callie, obviously, being at Ritholtz, you guys manage billions of dollars. We've talked a little bit about context and data behind all this, but how do you think about this in terms of client situations for your guys' portfolios at Ritholtz between both, I would describe it between education and action. So how much of it is educating clients on what is going on in the market so they're comfortable and confident with what's going on with their portfolio? And then how much of that education turns to action when we're actually taking steps to either change things or dial things up or back in their portfolios? And obviously, this is not financial advice. This is on a client by client situation. And this is more just a general context.
Yeah, so I'll give you 3 angles. So my job at Ritholtz is to obviously talk to clients about markets and what's happening in the context of their own investments, because when it all boils down to it, we care about our own situation. So I have to walk this line of this is what's happening in markets, but this is also how you have to contextualize it for yourself. So we do that in 3 ways. Obviously, I talk about markets, what's happening in them. That's been a really big conversation around interest rates and the Fed rate cut, for example. We have portfolios at Ritholtz, client-only portfolios, and we position them in ways, we call them strategic tilts, but that's a really jargony way of saying we lean into some investments more than others because of where valuations are, for example, where the economy is, how we approach investing. We believe in value, for example. We believe in looking for value regardless of the environment that you're in. So we naturally gravitate toward parts of the market where we see value. And then there are things that we can do on a client specific level too. So of course we have our client portfolios, but client allocations look very different across that. And we use this tool called Canvas. It's an amazing tool. Like, I don't want to get into financial advisor nerdery, but it's this tool that basically allows you to tweak our portfolios to your own situation, to your own tax needs, for example. So those are 3 ways that we approach it. For clients, the part that they see the most, or the parts that they see the most, are probably 1 and 3, mostly 3. But I think that's the importance too of, being able to look at every single angle of somebody's financial situation. Like at Ritholtz, for example, we have a full service team. We have tax advisors, we have insurance advisors, we have estate planners, we have a family office service here. We have the ability to kind of attack from all angles and help out with every part of the financial situation. So it's not just investments either.
Yeah, and I think this is where, the average consumer thinks they're somehow the perfect portfolio. And I think a lot of what you're getting at, like we have tilts, right? I think we tilts towards, areas with strong cash flow to value, we're globally diversified, small cap, et cetera. But having tilts is actually part of it is, hey, this is actually what we believe. And the other part is like, here's research, here's why we believe in it. And if you don't have any belief, you're never going to hold on to your portfolio, right? The average person who says, I heard this on a podcast, I did this, I bought it. The first year that doesn't do well, where do I change? What do I do? And then, what happens is that the next year, or what the year after that was right when that type of, value or small cap, et cetera, had that outperformance period. And a good portfolio is one that doesn't all move in the same direction. There might be some years where that does happen, but in general, it doesn't. And I like that you talk about customizing as well, because, we can sit down and say, hey, I believe you should have 20% international and 6% in emerging markets and 5% in small cap, blah, blah, blah. But if that person across from you can't get on the same belief, they're not going to have the portfolio. And so you can say, hey, great, I get that you don't believe in international. So we can pare that down a little bit, and let's hold that in your pre-tax accounts, right? Because you want your lowest growth assets in your pre-tax account. So at least if that happens, you benefit because lower growth in the area that's going to come out at income tax rates. And two, at least we have a little diversification. We still got you on board. But I think without that core belief and without the customization to who that person is, you're going to lose them as a client pretty quickly. And they're also going to be the ones who are like, oh my gosh, I told you, we should never done small cap. Look at the outperformance of large cap this year. And, that is just not at all where you want to be. You want to figure out like, how do we meet in the middle of what we both believe? Because let's be realistic, you shouldn't have 100% in the S&P 500, not investment advice, but, part of what you're talking about is value. You look at the S&P 500, it's growth, right? It's basically all growth, and you own about 6 stocks as a large part of your portfolio. And we can all look back 20, 30 years from now. None of those were the biggest 6 stocks that period of time. They're probably not going to be 20 years from now either. And that's why we can't just own such a concentrated area.
Yeah. Preach. The line that I use, and I think this sums it up the best, is, we as advisors and as market strategists, as, partners, as somebody, as part of we all work together to get you from point A to point B as smoothly as possible, with emphasis on the as smoothly as possible, because coming in, you might be shooting for the stars. You might, think that you can make a lot of money, but is that going to be the best trip for you? It might be really turbulent. You might not be able to handle it. And I'm not saying that as a knock on anybody's skills, but, life happens. For example, we all have different expectations of when we need our money. We all have different, things that make us tick. So when it all boils down to it, a financial advisor is there to help you to get from one point to the other as smoothly as possible. And the other thing I'd say, Tom, is, especially with Canvas and customization, is that a lot of times clients don't come in with, neat portfolios. And again, I'm not saying this as a knock on, how anybody invests or builds their path to wealth. But, for example, some people could come in with a huge allocation to one stock or one company because they worked there for a really long time and they took advantage of the employee stock purchase program, or, maybe they were granted equity options and they hit it big. You can't take a portfolio like that and just, go from 50% Amazon, for example, into a diversified portfolio like this. You have to have some customization and a plan for how you diversify the portfolio slowly and with tax considerations in mind, and with, different life events and, financial needs in mind.
Yeah. Well, one thing that you talked about at the beginning, I think that I want to bring back on this point is context. So all three of us post things online. A lot of us post content on social media. And oftentimes you'll see people say on social media, you should invest XYZ way. And somebody asked me recently, like, what's the biggest red flag when it comes to investing? And I said, like, one of the biggest red flags for me is just because somebody else is doing it means that you should do it. And I think when we think about context, think about even for ourselves, right? Like my portfolio probably looks different than Thomas's. That probably looks different than Callie's. And that's not to say like one is better than the other, but we're all probably trying to achieve different things. We're all coming to it from a different standpoint. We all started investing on a different day. We all had different thoughts around our money when we first started. All those investments have different tax implications. Like there's all these different factors that come into play when it comes into context. So if you're listening, like understand context when you read about investing. And somebody says, you know, Thomas, you mentioned like we see on Twitter, people say like, oh, just invest in the S&P 500. And it's like, okay, if you're willing to stick with that for the next 30 years, could you make money? Sure, I think you can make money. But the reality is like, is that the best thing for you in your situation? I have no idea because you have to understand the context of the entire situation.
Well, and I think the other thing too is, right, if you just started your Roth IRA and you're putting $7,000 in this year, is very different than, hey, I have a $10 million in my investment portfolio. Like the way that you invest, the way that you look at things is very different. And, you know, in my experience, what I've seen is actually like people don't realize that. A lot of times as they become pretty high net worth, they don't actually take risk off the table. They still have this concentration risk. They still own, you know, maybe just the S&P 500 or a few individual stocks that they picked. And, you know, you talked about this smooth ride, right? Like when you have 20 million in investments and your portfolio drops 50%, that's not a smooth ride. You really feel that. That's way different than my Roth went from 7,000 to 3,500. It's so different psychologically. And I don't think people realize what needs to happen after a 50% drop, right? If you were at 20, you get to 10, you need 100% growth to get back to 20. Like that isn't that easy. You know, I've sat down with some clients who have had 100 million in a stock. I sat down with a client that had well over 100 million in one stock and has watched it ride down to like 27 million. And still his thesis is the same, right? I don't know what that's considered risk tolerance wise, but I think, you know, this is what, when we work with these high net worth people, it is a very different game than what got you there. It really is. And I think people think that you need to take that risk, but let's say you have $20 million, the risk of what could happen on the downside is not worth the added benefit of being just a little bit richer, right? You're already at this wealth level that everything pretty much you want other than the 200-foot yacht, you can do. Like you need to start to be smart when you hit those levels.
Yeah. And I think everything that we're saying around this really boils down to knowing your why. So you don't need to get a financial advisor to do this. You know, I think advisors can help out on many different levels. But if you're sitting here listening to this and you see that social media advice, take a step back and have an honesty hour with yourself. Ask yourself why you're investing and what point you want to get to. That could be retirement. That could be, I'm investing for that beach house that I want to buy down the road. You know, I'm investing to pass on, you know, a certain amount of generational wealth to my kids. Defining that why and then understanding the number behind it can take you so far in understanding what investments you need to target, how much risk you need to be taking, and ultimately when you sell and what you do in drawdowns, for example. It's such a simple piece of advice, but I don't think enough social media influencers, for example, you know, really dig into the details of how to do that. Of course they don't, because I mean, tweets are 280 characters. TikTok videos are short. You don't have time to do that. But if you're an investor, the best thing you can do to start out, and it takes 15 or 20 minutes, be honest with yourself about why you're investing, when you need that money. Do a few simple calculations, get out a time value of money, you know, calculator. There are many of them online, and understand the rate of return that you need to get to your goal. And you'll probably shock yourself. Compounding is pretty crazy.
Yeah. I mean, I have some very high net worth clients, and I've been sitting down with them and I'm like, what happened to the last 6 to 12 months in their net worths? Like I'm sitting down with somebody this week who their net worth is up 3 million in the last 6 months from the market. Like as you become wealthy, that compounding really does its work. But going back also what you were saying about like, you know, what is the goal? What do you need out of it? Also goes account level. I think some people are like, oh, I'm a high risk investor. And it's like, yeah, but your kid's going to be in college in 2 years. Your 529 plan shouldn't be 100% in stocks. Or, you know, I've worked with some clients now that have advanced trust structures that are going to be for their kids when they pass away, and it's in cash, right? Like this, you have to understand the account, the use case, and how to best use them. Because if you put this money into an irrevocable trust and the goal is the most growth out of your estate and it's in cash, probably wasn't really the best thing. But on the same thing, right? Hey, if I'm about to retire and I need these funds and I'm in 100% equities and I'm going to need funds, some for the short term, you need to start to think about how do you carve out for different use cases other than my whole portfolio is high risk because I'm high risk, because
Mm-hmm.
that is not in reality how it works in real life.
And that is not what a social media influencer will tell you unless you follow Tom or Jacob or me.
Or you.
Well, I think the other thing too, though, is it depends on who you're working with, and I don't mean like what advisor you're working with, but if you're a DIY investor out there and you want to do it on your own, my advice that's not financial advice is to keep it as simple as possible, right? Because like you're not going to be, this is not going to be you're doing every single day, you're taking a look at what's going on. If you're working with somebody like Callie or Thomas or myself, and you want a more sophisticated portfolio and you want to add more complexity to it because you have somebody that's there helping you to manage the portfolio, I think that makes sense. And again, that goes back to like this general advice I see online. I don't want to sound like I'm ranting, but I'm ranting a little bit because like I hate seeing this advice online where it's supposed to speak to everyone, when in reality it's speaking to one specific person in one specific situation that's had one specific experience that's worked out for them, but that doesn't mean that you should be doing it too.
Yeah, and I don't want to put down anybody who's learning about investing, online through social media accounts, because I mean, you're doing more than the majority of Americans, right? Like you're taking the initiative to learn more about markets and investing and what's going on with the economy. I mean, there's a reason why you're listening to this podcast. You just have to be really careful because investing is a highly personal thing, and you're not going to get highly personal advice. Well, context. I was going to say advice. You're not going to get advice off of social media, but you're not going to get the context you need to make these really important decisions.
Totally. I think maybe the last thing that we just kind of hit on here is, what are you thinking about the markets moving forward? I think we talked about, the rate cuts happened, how you feel about that. But just in the last week, I was literally just Googling it as we've been on here. And if you Google like price targets, now it's like UBS, and it's just like everybody is coming out like 6,100, 6,200, et cetera. And like, I do not believe in anything anybody says. Like, what was it? Like last year was like 90% of places said that we are going to have a recession of like 30%. But I still think we have to talk about those headlines. And it almost makes me feel less confident seeing everybody else say it's going to be good. But like, how are you viewing this next 12 months or so?
Well, I'll start off by saying that price targets, I would put them in the bucket with social media influencers. You absolutely need context with them. Just to let everybody know, S&P price targets, whether they come from Morgan Stanley, Goldman Sachs, Bank of America, your brokerage, your favorite brokerage down the street. I have the utmost respect for a lot of Wall Street research teams, but they aren't meant for you. They're an institutional marketing tactic that banks put out, research teams put out to gain media attention, to help their institutional clients, because institutional clients need a number there, and it really is marketing. It is not a reason for you to buy or sell stocks. You cannot make a decision like that based on one number. But that being said, Tom, you bring up a really good point. A lot of people are bullish right now. A lot of people are really optimistic about the future, and that's great. Like I'm pretty optimistic too. I'd say I'm generally an optimistic person. The contrarian in me says, when everybody's optimistic, there might be something that we're missing. But I try to consider the attitudes of investors and, publicly facing experts with the allocations that they have. And right now, a lot of people are sitting in cash. We all enjoyed our 5% savings rates. And now that rates are coming down, a lot of us are still sitting in cash. So I think that there's still enough interest in stocks. It's still enough, I guess, cash that could go into the market where, I feel pretty okay with where the market sits right now. And I'll mention a few other things too. First of all, the stock market over time, over years and years, follows the economy and earnings. Right now, the economy looks okay. I would not say good. I would say okay, because the job market, we have hiring slowing down. We have unemployment, climbing up a little bit, and some of it is okay because good employment, people entering the labor force looking for jobs. Basically, the job market is a mixed bag right now. And if you want to pick one piece of economic context out of all the data you get, the job market is the place to look because 70% of the US economy is consumer spending. So right now the job market looks okay. We could see a little bit more life, a little bit more looseness and improvement in the job market if the Fed's rate cuts like really come to fruition and reinvigorate businesses and consumers. So we have that. We have a lot of stocks that haven't participated fully in this bull market. Small caps have been lagging large caps pretty much since the market low in October of 2022. A lot of rate sensitive sectors still look quite cheap relative to the earnings they generate. And, we're at a point where the bull market still looks young. The economy looks okay. The Fed is cutting rates, which should help breathe some life into markets and the economy.
Yeah.
I think looking over the next year or two, you've got a lot of reasons to be optimistic. So I'll say it like this. The fact that everybody's optimistic right now should make you a little bit more worried about the short term. Because when everybody's, happy about where things are going, then there's a bigger chance that a negative headline can throw people off. But I mean, for now, I really think the risk of sitting out of the market is a bigger risk than being worried about buying at the peak. And to be clear, there is a risk in sitting out of the market and watching the market gain when you don't have exposure.
Yeah, I mean, statistically, right, when the market's at all-time highs, the next 12 months are better than pretty much any other period of time. And that's just kind of the belief of momentum, right? When things are going well, things tend to go well. But last question I have for you is your belief that, you said you're a kind of a market nerd, history nerd on this. Is your belief that everything reverts back to the mean? And really what I mean by that is like, a lot of people are like, okay, well, US has been outperforming for basically the longest time in history. Typically US international switch off. Typically small cap is expected to have longer returns over periods of time. We talk about value, et cetera. That hasn't been the story we've seen for a really long time. And so we have this side of people who are like, that world's over. Now it's happening. Then this world who's like, I believe things revert back to the mean. And so actually, I think more allocation international now is the thing. I think higher allocations of small cap make sense now because the history says one thing. And so I feel like we're going that way.
I wouldn't call it reverting back to the mean. I just remind people that we live in a dynamic world, in a dynamic environment, and that those dynamics flow into your investments, into stocks, into different markets and how they interact with each other. And the moment you say that, nothing will ever change, we're stuck in this period forever, that's when it changes and it completely throws you off.
This is the Morgan Housel, right? The Morgan Housel thing is like, yes, the world changes, markets change, et cetera, but human behavior doesn't. And the stock market is the ultimate indicator of what human behavior is.
Yeah. And that's a great quote, by the way, because he's right. Some things just stay the same throughout time. He wrote a whole book about it.
Yeah.
But in terms of value, I mean, we're being a value investor, and there is a label here. I mean, value investors just constantly look for value stocks and they invest in those stocks hoping that the price of that stock matches the earnings and then some. That is an actual strategy. Value investors have had a really rough 10 to 20 years because tech has done really well. Higher valued or higher priced stocks relative to earnings have led the market higher for most of the past decade. It's been a really rough time. We don't know when that reverts, but we know that, being exposed to a bunch of different types of strategies can help you have that smooth path from A to B. So if I had to answer your question, yes, markets change and, sometimes markets look different and you need to have exposure to that different environment. Because if you don't, then you might be stuck in a vicious sell-off, or you might be stuck at a point where you can't take those steps forward to meet your goals. But I can't tell you when that happens. And I think that's one of the most frustrating parts of being somebody that watches the markets. I mean, you mentioned international, I think international stocks look really interesting right now because the dollar is coming down from a 5-year high and international stocks are very, very value oriented. International markets don't have big tech stocks, but the timing around it is anybody's guess. But looking at that, I think it makes sense to have a little bit more allocation in international stocks because there's a little bit more value and we acknowledge the fact that markets do change.
Yeah. Really good point. So I guess moral of the story is everybody in the long game over here is bullish, and we believe in international, because I cannot get over how much I have to argue about this of everybody who's like, why allocate to international? Because every international company is in the US, and there's all of these arguments and blah, blah, blah. But anyways, Callie, we really appreciate you coming on. Let everybody know best places to follow you.
Yeah, so I have a newsletter. It's called Optimistic Callie. It's for the long game investors. I am a long term investor. I'm very optimistic, and I think there are so many reasons to be optimistic over years and years and years. So I write about that. Check out Optimistic Callie. It's on Beehive. Check out the Compound Media. I appear on a lot of different podcasts and events that the Compound Media holds. That's an arm of Ritholtz. And follow Ritholtz Wealth Management on Twitter, on LinkedIn, on Instagram, and you can find me on Twitter and LinkedIn as well. Twitter is Callie A. Bost, and LinkedIn is Callie Cox.
Perfect. Yeah, everybody highly recommend following her. She's another great follow. But Callie, appreciate the time, and everybody, thank you for listening. Please remember to rate and subscribe, and we'll see you back for another episode next week.